Apple just became a $4.5 trillion company. The stock hit an all-time high of $316 in early June 2026, and yet the trailing PE sits at 37 times earnings, well above its 5-year average of 30. So the question is straightforward. Does the underlying business justify that number? In this video, we run Apple through the ClearMarket Signal Score, 5 factors, each rated 1 to 10, business quality, valuation, momentum, risk, sentiment. By the end, you will have a data-driven framework for evaluating AAPL in 2026. 3 converging forces define Apple's setup in 2026. First, Apple Intelligence, the company's on-device AI platform, launched with iOS 18 and iPhone 17. It triggered one of the strongest upgrade cycles in recent history. iPhone 17 revenue rose 22% year-over-year in Q2 FY 2026, reaching approximately $69 billion. Second, services is no longer a support segment. Revenue from services reached roughly $31 billion last quarter, growing at 14% annually. Services carries gross margins above 70%. Hardware sits in the mid to high 30s. Every percentage point of revenue mix that shifts toward services lifts blended margins automatically. Third, Apple has meaningfully de-risked its supply chain. 25% of iPhone production has moved to India, reducing direct China dependency. That strategic move followed years of tariff and geopolitical pressure. Business quality measures competitive moat, margin structure, and earnings consistency. Apple's moat is structural. Switching costs per customer have been estimated above $10,000. That figure accounts for the integrated hardware-software app ecosystem. Services gross margins are above 70%. Overall company gross margin reached 49.3% last quarter, a record. Revenue has grown in 12 of the past 13 quarters. Net income is $112 billion on a trailing 12-month basis. Free cash flow generation remains among the highest of any company globally. The one constraint on this factor, hardware still contributes roughly 50% of revenue. That creates concentration risk around a single product line, and the iPhone. Valuation is the most contested factor for Apple in 2026. The trailing PE is approximately 37 times as of early June. The 5-year average PE for the stock is 30.5. The 3-year average is 33. The current multiple is 22%. Above the 5-year mean. Revenue is forecast to grow 6.3% annually over the next 3 years. That is below the broader US tech sector's projected rate of 7.5%. The forward PE is approximately 31, more reasonable, but still demanding for a hardware-led company. The PEG ratio sits above 1, which historically signals that growth alone does not justify the premium. The counter-argument: services growth and the installed base flywheel deserve a software-like multiple. The data shows a company priced for continued execution, with little margin for disappointment. Momentum covers both price action and fundamental trajectory. The stock is up significantly from its early 2026 low of $243 to the current range above $300. Q2 FY 2026 earnings beat on revenue, EPS, Mac, iPad, wearables, services, and gross margin. iPhone revenue was the only line that missed, and by a modest margin. The company guided Q3 revenue growth of 14% to 17%. Year-over-year analysts had modeled 9.5% growth. The company's guidance was almost double the consensus. The board authorized a fresh $100 billion buyback program and raised the dividend to $0.27 per share. Fundamentally, operating leverage is evident. EPS grew 19% on 16% revenue growth in Q1 FY 2026. Historically, that kind of earnings beat combined with upward guidance revision sustains momentum. Risk examines the factors that could cause the thesis to break down. China is the primary risk. Greater China revenue has been under structural pressure. Domestic competitors, notably Huawei, have taken share in the premium segment. Geopolitical escalation could simultaneously disrupt supply chains and reduce demand. While 25% of iPhone production has shifted to India, China still anchors final assembly at scale. Regulatory risk is the second concern. Antitrust investigations in both the US and EU target the App Store. The App Store operates at extremely high margins. Any forced structural change hits services revenue directly. On the balance sheet side, the debt-to-equity ratio is elevated at 2.61 times. Net debt is approximately $92 billion for FY 2026. That figure is manageable given free cash flow, but it does constrain financial flexibility. The valuation itself is a risk. At 37 times trailing earnings, any guidance miss produces an outsized drawdown. Sentiment measures what the market is collectively pricing in and where expectations sit. Institutional ownership accounts for approximately 64% of shares, led by Vanguard and BlackRock. That level of institutional concentration creates both stability and crowding risk. Analyst consensus skews constructive, but a notable minority maintains hold ratings citing valuation. Wedbush has described recent dips as a generational buying opportunity ahead of the iPhone 18 cycle. The bull narrative, Apple Intelligence driving a multi-year upgrade cycle, is now consensus. When the base case becomes consensus, upside surprises become harder to generate. Retail sentiment has followed. The stock higher and maybe pricing in optimistic AI outcomes. The data shows sentiment is positive but not euphoric, a nuanced backdrop factor. Business quality rating, 8 of 10 evidence, 49.3% gross margin record, 70% plus services margins, 112B TTM net income. Structural ecosystem moat. Factor, valuation rating, 5 of 10 evidence, trailing PE to 37x, versus 5-year AVG 30.5x, peg above 1, revenue growth forecast below sector average. Factor, momentum rating, 8 of 10 evidence, Q3 guidance, plus 14, 17% versus 9.5% consensus. 100 BD buyback. EPS, plus 119% on 16% revenue growth in Q1, FY 2026. Factor, risk rating, 5 of 10 evidence, China structural headwind, App Store regulation. Net debt 92B, valuation leaves no margin for error. Factor, sentiment rating, 7 of 10 evidence, 64% institutional ownership. Analyst consensus constructive. Bull narrative is now priced as base case. Signal Score. 33 of 50 Apple is a high-quality business trading at a premium that demands flawless execution. The data supports selective positioning, not conviction at current multiples. Mistake 1. Confusing product excitement with investment signal. The iPhone 17 launch generated significant consumer enthusiasm. That enthusiasm is not the same as a margin of safety at 37 times earnings. Historically, stocks priced for perfection underperform when growth simply meets, not beats, expectations. Mistake 2. Ignoring services margin mix in the revenue headline. When Apple reports total revenue growth of 17%, many investors evaluate it as a uniform number. The data shows services growing faster than hardware at dramatically higher margins of 14%. Services growth rate changes the quality of earnings more than the headline revenue figure suggests. Mistake 3. Anchoring to China risk without quantifying the exposure. China risk is widely cited. Few retail investors actually model the revenue. Percentage at stake. Greater China represents roughly 15 to 20% of total Apple revenue, a 10% decline in China revenue would reduce total company revenue by approximately 1.5 to 2 percentage points. Quantifying the risk is different from simply acknowledging it. Mistake 4. Treating the PE ratio as a standalone conclusion. 37 times earnings sounds expensive. At 30 times it sounded expensive too. The relevant question is whether the blended margin improvement from services justifies a premium multiple. Based on the numbers, that is a legitimate debate, not a one-line dismissal. The data shows Apple is a structurally strong business running at elevated expectations. A signal score of 33 out of 50 reflects that asymmetry. Business quality and momentum are clearly positive. Valuation and risk are real constraints. That combination does not produce a clean directional signal. It produces a conditional one. The conditions are services growth sustains above 12%. China does not materially deteriorate, and Apple Intelligence continues to drive hardware upgrade velocity into the iPhone 18 cycle. If those three hold, the premium may prove justified. If anyone breaks, the multiple compresses faster than the fundamentals deteriorate. That is the framework. Use the data if you want to see the full signal score on NVIDIA. It drops Thursday. Subscribe and turn on notifications.